Hi guys, and welcome back. Today we're going to move on to the second chunk of the finance topic. The first chunk, remember, was on the role of finance, so considering things like the interdependence between finance and the other key areas, considering objectives like growth, profitability, etc. Okay, now we're going to move on to more things that are an influence on financial management. So if you're the chief financial officer or the person in charge of finance for an organisation, in this chunk of the course, we're really going to be considering, okay, what are the major influences that those key people need to consider? Again, thinking about it in the context of businesses like Qantas. Okay, so as you can see there, some of the key things we'll look at are the sources of finance. So organisations that need finance in order to be able to expand, to be able to potentially buy competitors. Remember, we talked in chunk one about organic and inorganic growth. That inorganic growth through acquisition may well be a reason why an organisation needs to get access to capital. Okay, we'll cover that, some of the different sources they might go to in order to be able to achieve that outcome. We're going to also look at different financial institutions, so try to deconstruct some of those organisations which you might have heard of, like investment banks. What do they actually do? Okay, then we'll look at government. What role does the government play and how are they an influence on financial management? And then finally, global market influences. So considering things outside Australia and how they, again, might be an influence on financial management. So in today's video, we're just going to focus on the first part of this chunk, which is internal sources of finance. There's only one really major internal source of finance that an organisation has access to and is an influence on financial management, and that is retained profits. So retained profits, as we've spoken about this in chunk one, retained profits is money that the organisation has kept from previous years, and from previous years' profit. Remember, on our balance sheet for I Wish Toys, they had net profit under their owner's equity section, and I said in class that is otherwise known as retained profits. I think they had $250,000 or thereabouts. So that's money from previous years that they've put to one side, which they can use in the future. If you can see on the screen there that I've got an example of BHP's retained earnings. At present, as at 30 June 2016, in US dollar terms, their retained earnings are nearly $50 billion, okay, 49.542 million, down from about $60 billion in 2015. So they've spent about $10 billion of their retained earnings from 30 June 2015 to 30 June 2016. So that's the major internal source of finance. So internal meaning they don't need to go outside the organisation to acquire that finance. They have it already at their disposal, and how they use it and what they use it for is up to the company. Obviously, for an organisation like BHP, given that they are a public company, the shareholders would want to be comfortable that the management is using those funds appropriately. And generally, retained earnings will be used for, particularly for companies as big as BHP, for things like acquisition, buying up competitors, potentially investing in new machinery if need be, maybe upgrading existing facilities within a manufacturing plant. Those types of fairly large, capital-intensive instances. So that's the only real example of retained profits. Some advantages of retained profits are that there is no interest associated with it. There's no loss of control associated with it. You're not selling more of your company. There's no long-term obligation to repay it. It's simply money that's been kept from previous years. So that's it for today, and next video we'll move on to external sources of finance with a focus on debt.